We're talking to Jim McMahon of Your Finances. That's not exactly right, but I'll go with it. Joe Lopresti, how are you there?
Doing well, Kenner. How are you? That's a name
Doing
out of
well. Yeah,
business,
I
Jim
like that we
McMahon.
start out with that because it sounds like you are the quarterback for people's finances, not only in Chicago where you're from, but all over the country because you have clients all over the country. But we're specifically going to be talking about ways that you are the quarterback of, well, people's finances. Sound about right?
Yeah, yeah. Quarterback, or we like to refer to it as their personal chief financial officer. For the business owner client that they may have a CFO, right, for their business, but nobody's really looking out for them and making sure all the plans are advocating for the life they want to live and the direction they want to go.
Yeah. So, all right. So let's just say I'm a pretty good net worth. Let's say I'm pretty loaded. I'm a business owner. Uh, Give me one piece of advice that will make me, I don't know, become a billionaire.
So I think it's the coordination of planning between the business planning and the personal wealth planning. Today, I think most business owners do that in a silo where they may have business advisors they work with or their management team or whatever it is. They have financial advisors that they work with, insurance, financial investments, whatever that is, but they're not communicating and collaborating, and they're
Mhm.
missing synergistic opportunities. And they're also exposing some gaps in the planning that sometimes expose dangers.
Yeah. I mean, that's why I use the term, jokingly, but seriously, Jim McMahon, who was a famed quarterback of the, Chicago Bears back in the day, he was kind of a ringleader, kind of the leader of the team with his offense propelling him forward. Sounds like you're the kind of the one to bring everyone together, working as a cohesive team.
Yeah, quarterback. Some people I've heard describe it as the coordinator, right, of the offense in that case, right? And we use a lot of football analogies actually in our business where what we tend to find is our clients are really good at driving the ball down the field. They built businesses, they're creating value, they're building wealth, and they're just very good at doing what they do. But the difficulty and challenges start to arise once they get to the 20-yard line, that red zone. They start
Mm,
to think about their end game,
yeah.
and that's where all these different decisions that they've never had to make before start to come into play, and it's just not what they have done and what they're good at, what they're experts at.
Yeah. There's 2 things there. Number 1, I had to use Jim McMahon because I couldn't think of a good, offensive coordinator, so I had to use the quarterback, by the way. Number 1. Then number 2, I think, it's kind of a shame when people say, "Oh, I'm gonna do it myself." When I say it, meaning, decide to take the income out of their portfolio because 'cause they've usually never done that before. You know what I mean? Let's say someone's amassed $10,000,000 net worth, and then all of a sudden they start taking income and they do it wrong. You only have one chance to succeed or fail in retirement. And I consider retirement the longest vacation. That's really all it is. You don't want to work on vacation. So I think it's important, it's incumbent upon us as professionals to help, retirees to take income, but also to kind of learn how to take, income, but also, well, not let them make mistakes along the way.
Yeah, not make mistakes. Uh, you know, tax tax efficiency on that income
Mhm.
is huge because I mean, most of our clients are everyone's different, right? But let's say they need 300,000 a year or whatever to fund their lifestyle, wants and needs, etc. Well, if that income and cash flow is tax efficient, it goes a lot farther than if they have a high tax rate on that income. And,
Mhm.
obviously that drains their portfolio and net worth quite a bit more.
I used to hate I remember in college, undergrad, I used to hate taxes, I used to hate studying and doing everything, and then all of a sudden, I became a business owner, consulting with other business owners, then I figured out, well, wait a minute, if I could lower a tax liability by whatever, 33%, let's just say 33%, well, therefore, the amount of money you're starting with to invest is whatever, instead of $100, it's $130, let's just say, versus someone who doesn't care about taxes working with $100, who's gonna end up, further ahead? Well, the
Yeah,
person who's mitigating the taxes. So that's pretty smart that you mentioned that.
absolutely. And then the withdrawal strategy is also very important.
Mm. Yeah.
What I like to tell people is that there's this hidden tax out there not just paying an income tax, but I call it the dumb tax. And that's, people don't know what they don't know. They may feel that they're in control and they know all their options, but a lot of times later, and you find this when business owners sell their business, they come back with a lot of regret because they found out there were different options, different tax strategies, different transaction methods, whatever it is. They didn't, become fully educated on the whole process, and that's what creates the regret that they come back later with.
Well, so what would you say is a good strategy for someone who's, let's say that, they have almost no basis company. Let's say it's worth whatever, 100,000, now it's worth $10 million. They want to retire. What are some strategies you suggest when it comes to, selling someone's business? Let's say it's a doctor's clinic.
Yeah, so just pure on the transaction you're talking about, or
Yeah, what are some strategies you suggest that would make someone happy because they've saved some money on their taxes? They don't want to pay Uncle Sam. They're not buddies with Uncle Sam.
yeah, well, that depends on how proactively they get in planning that. So if they want to start trying to minimize or eliminate the capital gain tax on the transaction itself, generally have to start that a few years ahead of time. There may be entity structure changes that they need to make, or trusts that need to get set up, and you can't do it, when you have an agreement in place, right? You have
Yeah.
to do that ahead of time. But there are after the fact strategies and programs that, yeah, I'm sure that you're familiar with a lot of these that you can put in place that could help offset the tax
Mhm.
on the transaction. But I like to, if it doesn't show up on the tax return to begin with, that's the best way to
Yeah.
mitigate taxes.
That's a good point, man. I was just, was it yesterday? Yeah, it was just yesterday. I was talking to a new client and they said, "Oh, I'm gonna have a huge tax liability. What can you do?" And we threw out, just because kind of the situation you mentioned, I guess also I kind of am alluding to, we suggested a 453A where they didn't have to, pay all their taxes at once. They're spreading it out. And so that's one way of not having to pay their uncle who they're not buddies with, that being Uncle Sam. But anyway, it sounds like we're in alignment on some of the tax strategies, because if you could, again, lower some of the tax liability based on some pretty efficient strategies, you don't have to give as much to Uncle Sam as you think. You have to, just like you said, you have to start planning early. So that was really, really smart. So, okay. So, and it sounds as though you, and I like this, you work with, I guess, a financial, or you are a financial advisor as well, but, a tax person, a lawyer, you work with everyone on the team to, again, move the ball forward. So, what's some things that are pretty important to, let's say, an entrepreneur as they're selling out? What's some important things with respect to that team that you find key?
Collaboration, and they're talking with each other. I like to ask a business owner, when's the last time your attorney, accountant, wealth manager, business advisors all sat around the table talking about you and your agenda, as
Hmm.
opposed to you sitting at in their office talking about a specific silo, right?
Yeah.
The accountant or the financial advisor or the attorney. That's where you miss synergistic opportunities that could
Yeah.
be created that really accelerate your wealth accumulation. And that siloed planning also exposes sometimes some dangerous gaps where, the attorney isn't talking to maybe the insurance person, and you don't, you don't list the trust on your
Yeah.
your umbrella policy, and it exposes risk to trust assets. So getting the coordination in place is huge, particularly for business owners, because they just have so much added layers of complexity that,
Totally.
you know, retirement, W-2 employees that most financial advisors are dealing with, they don't have that complexity, and therefore they're not used to recognizing that risk and mitigating it.
It's so important because you're right. Entrepreneurs have so many things to think about, and usually a lot of their net worth is tied up in the business. But there's ways that, you know increase the net worth of a business, and if you start preparing earlier rather than later, you're better off. Plus, you could do things in a cleaner fashion. And to your point about, working together, if everyone's working together as a team, as Jim McMahon with the Chicago Bears back in the day, working together, it you can completely plan and less things fall through the cracks, and that's really important. People don't think about that. Instead, you know, Just yesterday, I was talking to a lady, and they're starting to plan now for 6 month uh, exit on their business. They're not at all organized. I mean, their books are a mess, et cetera, et cetera. But at the same time, and she's not talking to her. Well, she's just talking to her bookkeeper. She's not talking to a financial advisor. She's not talking to an attorney, even their estate planning attorney, by the way, or a tax attorney. Not talking to a CPA who's never done an exit, which is weird. I mean, it's really important if you want to, have money put away for retirement. The earlier you do it, the better, and the more collaboration and communication between all the key professionals, you'll be much better off in the end.
Yeah, no, no, you're right. And the other part of that, I think, is a lot of business owners, one, don't know what the value of their business really is. I mean, they may have an idea in their mind, but really getting a good assessment of that value today, knowing the industry that you operate in, what are the ranges of values that companies tend to sell for, and assessing your business qualitatively, and placing it where would you likely be in that range, and what are some areas, like for that client that has 6 months, that's not a lot of time, but if they had 3 years, they may be able to work on that qualitative part of their business that maybe is a little weak, and get that to look more attractive in the eyes of a buyer, and they'll get a higher multiple on the sale of their business.
In this case, they didn't want to sell it today, and they thought 6 months was too long. So that's
Oh,
kind of funny.
yeah, it's tough to sell a business in 6 months if you're just
Yeah.
starting. It usually
Yeah,
takes
especially
two
when you
months.
have just the bookkeeper who's doing all the stuff. The books are a mess. Yeah, that's
Yeah.
yeah. Anyway, that's pretty typical. So, by the way, I always forget. How does someone get a hold of you if they're interested in you being a quarterback or you being the offensive coordinator, et cetera?
Yeah, so my company is Clearpoint Family Office, and you could visit our website, clearpointfamilyoffice.com. They could, get a hold of me there, right? You could schedule a time to talk. Look me up on LinkedIn, Joe Lopresti, on LinkedIn. I also wrote a book that is specifically for business exits. We like to think of ourselves as advisors for the full life cycle of a business owner, but this book specifically deals with that end game planning, and that's Exit by Design is the name of the book.
Mhm.
And there's a website for that too, exitbydesignbook.com.
EXITBYDESIGN.com.
I think that was right.
Yeah. So what's one thing we have not talked about that can add value to, I guess, a business owner that is looking to exit, or I don't know, anyone who you think you can add value to who's watching and listening? What would you think that we should be telling them as we end the show?
Um, so I would say, know what we call your freedom point, know what that number is, right? So where your business is valued and where you need it to be valued to be able to live the life that you want to live is important. And equally important is to have a mindset change. Most business owners think of their business as providing their income and lifestyle needs today, but we like to have our clients shift that mindset to maximizing the enterprise value of the business. And it's not just about providing income, it's about all of these qualitative assessments or criteria that a buyer is going to look at. Right now, if a business makes $2 million in EBITDA, um, and another business makes $2 million in EBITDA, they could be valued at completely different levels if one business owner has to work 60, 70 hours a week, and the other one has a good team running the business and they're only putting in 10 or 20 hours a week.
Yeah. What? So in before we close up, what's a mistake that's common to entrepreneurs as far as they're exiting? Your book, Exit by Design. What are some things that they do wrong, typically outside of the things we've talked about so far?
So I think some of the things that you tend to see frequently is the business is very much dependent on the owner. Um,
Hmm.
and that's something that a buyer is going to look at, right? They're going to come in and look at, if you're at the hub of everything that's going on in the business, then if they're going to buy it, that business doesn't have a lot of value unless you plan on working for them.
So what you're saying is someone who's got a machine going, maybe like, E-Myth, Michael Gerber, someone who's got a machine going might be valued more, probably will be valued more than someone who's based on a personality, cult of personality. Their company probably wouldn't you know, be able to charge as much to a buyer because if the business owner leaves, yeah, there's some of the revenue is going to leave. So I think what you're saying is the business is a machine is probably going to make more in its sale versus one that's based on a personality, based on an owner, correct?
No question. No question. If it's a self-running business, more or less, it's gonna be a lot more valuable than one where the owner has to step in and
Yeah.
handle all the sales and all the client, customer relationships
Yeah.
and so forth.
Yep,
So,
yep, yep, yep. I get it. I get it. It's perfect. One last time, how does someone get a hold of you? I know it's exit by design, but go ahead.
yeah, so, clearpointfamilyoffice.com is the website that you could check out our company and get in touch with me if you would like to have a conversation.
Wow, this has been helpful. I hope that, if anyone's thinking about, selling their business or even before, or even, I mean, contemplating selling their business, you do the full life cycle of the business, they should reach out to you. And I think it sounds like, you know what's going on. I mean, it's important. As we talked about, income at the end of one's career is really important because you only have one chance to succeed at that.
Yeah, that's, usually the biggest transaction of your life, right? So why not maximize that opportunity?
That's exactly right. Again, retirement, in my opinion, is the longest vacation. You might as well get prepared because you don't want to go back and work at nothing against it, but you don't want to go work at Walmart, as an example.
Right, exactly.
Thanks again. I appreciate it.
All right, Connor, I appreciate it. I enjoyed it.
Good times.